Why should you take full advantage of your TFSA here in Canada? The TFSA is probably the most underutilized tax shelter or account that we have here in Canada, just due to the fact of lack of education and lack of financial literacy. We're actually very lucky to even have a TFSA. There is nothing like the TFSA in the United States. After tax income goes into the TFSA, and when it comes out, we're not taxed on it. Why should you take advantage of your TFSA and build out a portfolio over the long term? Of course, I'm talking about long-term investing, not day trading. I'm talking about long-term investing. Why should you partake in long-term investing and invest for your future self? Like, why should you do that? Maybe you might think that, why am I, saving all this money and investing it when I could spend it and go on vacation? I can do this and that. Well, when you buy a house, you're putting way more money into a house for way less return over a long period of time. But the reason that people do it is because of the utility of a house and living in it and the material nature of it, where you can show it off and everyone can see, oh, this is your house and you have this space and it's you. Because I think innately humans, we're very selfish, and that's why a house is so appealing to a lot of people, right? And you sink all your money into it without even doing the numbers, and just because the bank qualifies you for the house, you buy the house, right? Now, in a TFSA, it feels like 90% of the population is not going to actually fully utilize it properly. The biggest problem that we have is we don't have enough time, right? Like, you wish you had more time. You can make money. You can work all the time and make as much money as possible if you wanted to. All we want is time, right, in life, to do the things that we love, spend time doing things that make us happy. But because of the way the system is set up, majority of the time, you start out, you're working a job. Depending on your situation, you might be working multiple jobs, especially in a high cost of living place like Toronto. If I told you there's a way for you to free up some of your time, of course, you're going to be interested, right? So my goal is, and what your goal should also be, is to build up your TFSA over a long period of time high enough so that, first of all, you have a lot of capital contributed as well as capital appreciation from the equities that you have purchased. By equities, I mean stocks. In Canada, let's say you buy, bank stocks, you buy Shopify, the index ETF that I always recommend, VFV, to invest in the American economy. So you have exposure to Canada and the US. You receive dividends, right? Unless it's a growth stock like Shopify that one day might pay dividends. You don't know. We don't know, right? We thought that, Google would never pay dividends, and they do. Same with Meta. But anyways, bank stocks like TD Bank or RBC, people buy them for the dividend yield. It pays you a high dividend yield. And that dividend yield is very important because, say you start investing in your 20s, and once you get to hit your 40s and 50s, remember, you have to consistently invest and buy shares and dollar cost average over time. Whenever there's a dip, you buy, or just dollar cost average, and let's say you buy 5 shares a month or 2 shares a month or whatever it is, right? Just be consistent. Throughout your life, through the ups and downs of the market, just be consistent, because you're buying a quality asset that's producing cash flow, right? That's for stocks. But again, you want to know what you're doing with the stocks, but blue chip stocks over a long period of time, you should be okay. But again, not financial advice. Stay with me here. Ideally, you buy these blue chip stocks that pay you dividends, and you build your portfolio. You build your portfolio inside of your TFSA. You build it big enough. So let's say over 10, 15 years, you now have a portfolio value of $150,000. And most people will never get there because, just because of the lack of financial education and the fear of the stock market, and all their money sunk into their house. Most people will never get there. I'm talking to you, the people that are thinking, okay, I'm never going to afford a house in Toronto. I'm not going to save a down payment. Does it make sense to buy? I'm going to rent. Well, you got to do something with your money to build your wealth. And this is where the TFSA comes in. So let's just say you started at 20 and you consistently invested your money, and now your portfolio is worth $150,000. Am I saying, hey, you should go pull that money out? No. The dividends that you're getting every quarter or every month, depending on what companies that you own or ETFs that you own, the dividends that you're getting, those are tax-free. And that's truly passive income. People talk about passive income with real estate and all these other things, but true passive income is the money that you invest. And in Canada, we're lucky because we have a TFSA. The money that you invested in, let's say, use TD as an example, in TD stock 10, 15 years ago, is now working for you and is paying you every quarter. And you've accumulated more and more shares. A lot of people talk about, you got to reinvest your dividends, but it's your choice. You don't have to reinvest those dividends. Say 15 years later, that tax-free money that you can pull out of your account, tax-free, no one's coming after you. You can fact check me on this. You pull that money out and you can use that to pay for your car loan, or hopefully you don't have a car loan 15 years from now. You can pay for your car insurance, maybe. You can pay your phone bill easily. You can easily pay your phone bill, right? If you invest enough, right? Your phone bill should be free for the rest of your life if you do this correctly. This is with tax-free money that your money is making on top. If you were to get your portfolio big enough, and it is possible to get your TFSA to, $300,000, $400,000, $500,000, maybe even bigger, depending on how much you're able to invest, because we have a large amount of contribution room. Especially, we might be approaching almost 100K in contribution room, especially if you haven't touched it. It is possible to dump a lot of money in there, and if you know what you're doing, you got to really know what you're doing, obviously. Do not just go in and buy the stock I'm talking about, these stocks that I'm talking about. But I'm just trying to tell you here, like, what can happen if you actually learn and do things correctly here. You can have let's say you have a $250,000 portfolio and you're getting dividends, and you decide you don't want to reinvest the dividends when you're like 45, 50 instead. Say you're getting $700 a month. You could use that for vacation, right? Like, I don't know what a vacation is going to cost at that time, but it's money in your pocket that without selling your principal, your equity is still in those stocks, right? You still have ownership in those stocks, and yet now you're taking this money out and you're paying for your phone bill, you're going on vacation, you're paying for gas, you're paying your car payment if you have one, or your lease payment or whatever, you're paying your property tax, you're paying part of your mortgage. This is all money that you wouldn't have at all. This would not exist if you hadn't invested, right? And this is tax-free money. Like they say, like how you build wealth and how the rich get richer, or how the rich stay wealthy, or whatever. How you build wealth is by spending less than you make, saving that money, and then investing that money in a tax-efficient manner. And we have a TFSA for a reason. It's kind of like you figure it out, you're good. If you don't figure it out and you fall into the trap that everybody else falls into, it's tough. It's going to be tough for you. My vision personally is to build up my TFSA as big as I possibly can. And let's just say, by the time I'm in my 50s, like obviously everyone wants to get rich overnight, right? Like I'm talking about just something that's actually realistic. It depends on your income, right? In these examples, I'm assuming that you're just staying in your job, you're getting incremental raises. I, obviously know that my income is going to be drastically higher a few years from now, and I'm going to be able to contribute more and more and more and more until I max out my TFSA. Then you go to the RRSP, but I'm just talking about TFSA specifically. The RRSP, if you put money into it, when you pull it out, unless you're buying a house or you're paying for your education, your tax, there's penalty, there's tax, you pull it out early. I aspire to build my portfolio big enough so that I can actually show you this. The moment that you see it, and I've seen other, like you can just search up on YouTube, TFSA portfolio update, and there's people, $30,000, $60,000, $100,000, $200,000 portfolios people are showing, and those videos get a lot of views because this is real shit. I think it was during the pandemic, I think 2020, 2019, something like that. I was searching it up. You're researching stuff online. You want to look at content that's relevant to you. I've seen someone in Canada comment on an investing related video of somebody in the US asking, what is a Roth IRA? What is this platform? What can you talk about Questrade? And that person doesn't respond because they're in America. They're in the United States. They don't know what you're talking about. But you got to put the word Canada in your search, or if it's a recommended video, you got to realize, okay, what country is this person in when you're trying to learn this stuff? I was looking up Canadian personal finance YouTubers, and there was this one guy who showed his RBC. At that time, there was no Wealthsimple. Wealthsimple was either in its infancy or not existing at the time, and this guy was showing his RBC stock portfolio, and it was like $1 million, and that really got my brain thinking. How do you get there? Well, first of all, the main thing is you got to make a lot of money, save a lot of money, and then put it in there, right? The average Joe is not probably going to get there at a young age. In your older age, if you do the right things, there's no reason why you can't get there. And in your older ages, you should be able to travel as much as you can. You can easily build up $1 million TFSA. In 20 to 30 years, there's no reason why you can't get there. You can still enjoy your life and still contribute to your TFSA and get to millions of dollars. And once you get to that point, you have dividends, sure, but you can also reinvest those dividends and then get to a point where, say you want to travel the world, you pull out $20,000 tax-free from your TFSA and go travel. do what you want to do. The FIRE community, I don't know if you guys have heard of the FIRE community, but FIRE stands for Financial Independence Retire Early. There's a whole community of people that do this. It's going to sound crazy to a lot of you, but once you learn the power of investing in the stock market, there's no debt associated with investing in the stock market, unless you're talking about margin and options and all those things that people get tricked into doing that because they're promised this like vision of getting rich quickly and all that stuff. But you're day trading. That's not investing, right? You're not investing. Don't do that. You have $1 million portfolio. You should pull out 20,000. Your equities are still going to grow. Like you're going to make up a lot of that when your account is that big, or even like, let's just use $500,000. Like your account is that big. You are going to get to a point where it's going to take care of you. Like that 500,000, if it grows even 5%, what's 5% of 500,000? 10% of 500,000 is 50 grand. If your portfolio grows 10% in a year, you're net positive, even if you pulled out 20. Just think about that. Like there's so much power in that. You don't need to sink all your eggs into your principal residence for the rest of your life. Like learn this before it's too late. You know what I mean? Just really do the numbers. Like think about it. Really do a deep dive and look up videos like this. Just start thinking about it. You can create so much freedom for yourself to travel and do the things that you love, spend time with your family instead of working multiple jobs to pay for your house. You got to choose your barrier, right? Is your barrier affording a house so you can keep up with everybody else and play this game where majority of the houses are unaffordable? It doesn't even make sense to buy it based on the rate of return you're going to get. Or do you want to actually put in some work? You don't have to spend any money. You just have to spend your time learning. And that'll provide so much in literal gains for you, right, over your lifetime. And then maybe at some point your portfolio can generate enough passive income that actually makes sense for you, combined with your income and your passive income from your portfolio, to actually afford a house in a popular city. Otherwise, you just got to move away, man. Like it's not the end of the world. Like if you want to own a house that badly, just move away, move far away, own a house, and you can still invest, right? Just wanted to talk about that because I'm very, very passionate about this, and that is why I invest. I don't invest so that I can see this number in my portfolio. There's utility behind it, and I'm going to access this money in the future, and I'm going to use it to create financial freedom and free up my time. Once I max out my TFSA, I will obviously max out all the registered accounts, the RRSP as well. Let me know your thoughts on what I just talked about, and hopefully it sparks a light bulb moment and you start to think about things a little differently. All right, see you guys in the next one.